One of the advantages of having a good credit score is access to favorable finance products. Good credit loans are any type of loan offering fair terms and lower than average rates. If you have a strong credit history and reliable source of income, you can access preferable rates for your loan. Good credit loans can take the form of home equity loans, lines of credit, or home equity lines of credit. However, for the purposes of this article, we will be examining good credit personal loans. These personal loans are typical of any type of personal loan, typically requiring no security. This means that you don't need to use your home, vehicle, or other assets as collateral. Here are the Smart Investor Selects picks of online loans for good credit. 1. Upgrade. If low fixed rates, affordable monthly payments, and no prepayment fees are your jam, Upgrade is a good lender to consider. The application process is simple, and most borrowers see the money in their bank accounts within 24 hours of approval. In order to be accepted by Upgrade, you must have a credit score of at least 620. Upgrade allows its borrowers to take out loans ranging from $1,000 to $50,000, and they offer free credit monitoring throughout your borrower period. Despite having offices in Phoenix, San Francisco, and Montreal, Upgrade isn't available in all 50 states. The great thing about this company, though, is they offer two different ways to pay off your loan. Borrowers can choose to make single monthly payments or go with a fixed rate 36 or 60-month payoff term. Despite the mostly positive light this company has, there are a few things to keep in mind. They require higher rates among those with excellent credit, require free cash flow, and they have restrictions for investing. Along with these, Upgrade also charges an origination fee. 2. Discover. Unlike the other lenders on this list so far, Discover is one of the few companies that lend to residents of all 50 states. They also don't charge an origination fee and have a helpful loan calculator on their website to help you get started. They have flexible repayment terms, fixed rates, and have a staff of 100% US-based loan specialists available to help you. To apply for a personal loan with Discover, they only do a soft pull inquiry, but you must have a minimum yearly income of $25,000. Your credit score also cannot be lower than 660 in order to be accepted. Discover is good because they have competitive rates, and borrowing from them means you're making payments directly to the creditor. The only trouble with Discover is that the application process is longer than others, and they charge a pretty hefty late payment fee. They also don't allow joint borrowers, and the max amount able to be borrowed is less than many other places. The loan range for Discover is between $2,500 to $35,100. 3. SoFi. SoFi is a credit company that offers a variety of personal loan options. These options may be used for credit card consolidation, home improvement, family planning, travel, and even for weddings. They don't charge any fees for their services and are a good loan option for anyone with a credit score of at least 680. This company offers competitive rates and allows for joint applications too. Unlike other lenders, SoFi has unemployment protection in the case of falling on hardship. They have competitive rates, only do a soft pull inquiry upon application, and offer an auto-pay discount too. SoFi is a fixed-rate lending company and has term limits ranging from 2 to 7 years, depending on your loan type. When borrowing from them, SoFi offers you anywhere between $5,000 to $100,000 for your monetary needs. These certainly are great benefits. However, there are some things to keep in mind before you decide to move forward. SoFi has high requirements for their applicants and slow turnaround times on their loans. They require a higher minimum amount, limited usage, and they aren't available in all 50 states either. Upstart. Upstart is different from its competitors in that it uses an AI system to screen for credit rather than the typical FICO score ratings. They were the first company to receive a no-action letter from the Consumer Financial Protection Bureau, which is meant to reassure consumers that Upstart practices are completely safe. The quick turnaround times and modest income requirements make this lending option a popular choice among many. Upstart doesn't charge a processing fee, and borrowers aren't penalized for making prepayments either. They also offer quick turnaround times and use soft pulls for all applicant inquiries. The minimum income requirement for borrowing with Upstart is $12,000, and anyone with a credit score of at least 580 is likely to get approved. With Upstart, you have the ability to borrow between $1,000 and $50,000. Despite these clear benefits, Upstart may make some hesitate because they are a newer company and don't have much reputability. They charge higher interest rates than other companies, even on those with excellent credit, and they don't allow joint borrowers either. What are the expected loan rates for good credit? Since personal loans are unsecured debt, the rates are typically higher than a mortgage or auto loan. One of the biggest considerations for the interest rate on your loan offers is your credit score. If you have good credit, you'll have the best chances of lower rates. However, lenders will also look at your debt-to-income ratio. This is your monthly income divided by your total debt monthly payments. If you have a low DTI, you will attract a lower interest rate. Lenders will also look at your debt ratios, annual income, and other factors to determine your score. The current personal loan rates range from 3% to 36%. With a good credit score and low DTI, you're more likely to be at the lower end of the scale. However, to obtain the lowest possible rates, you would need an excellent or exceptional score. With a good credit score, there is a likelihood that you'll be able to access a number of different products from a variety of lenders. While this is a great way to obtain a superb deal, it can make choosing the best personal loan a little tricky. So, here are some considerations to compare products and find the best deal. Obtain quotes from multiple lenders. There are lots of lenders offering good credit personal loans, but each lender will offer different rates, terms, and fees. So, it is important to obtain quotes from 3 or more lenders. This will allow you to make an accurate comparison of what is available to you in the current marketplace. Choose lenders that don't use hard credit inquiries for loan offers. Many people are wary about getting multiple loan quotes or offers as it may impact their credit score. However, this only occurs when the lender uses a hard credit inquiry. Fortunately, many lenders allow you to obtain an offer through a soft inquiry. Soft inquiries allow the lender to find out what rate and terms you will qualify for without impacting your credit score. It is only if you decide to move forward that a hard inquiry will be placed on your credit report. So, be sure to shop around with lenders that only use soft inquiries to protect your credit score. Compare apples to apples. When you're comparing loan quotes and offers, you need to ensure that you are comparing like-for-like products. If one lender offers a lower monthly payment, but the term is a year longer, you'll end up paying more in the long term. You also need to check that the lenders are offering the same type of rate. Most lenders offer fixed rate deals, but variable rate offers tend to have a lower starting rate. Just be aware that this rate can increase at any time, so you will need to factor this into your comparison. Check the small print. You also need to check the small print for any additional fees or costs that may apply. A good example of this is prepayment penalties. If your circumstances change and you want to pay off the loan early, a percentage fee could apply. It is important that you check all the possible fees and penalties to ensure that you're comfortable and that one lender does not charge far more than the others. Assess the total cost. While your primary concern may be how much you'll be paying each month, it is important to look at the overall costs. Don't just look at the basic interest rate, but rather compare the APR. This is the annual percentage rate that will show how much you will pay for borrowing the money per year. Lender quotes and offers often include calculations on the total cost over the lifetime of the loan. This is a good way to see how the interest compounds and how much you will pay overall. There are a number of reasons for taking out a loan, but this can also influence the average loan amount. In this chart, with LendingTree customer data, you can see that credit card refinancing has the highest average loan amount followed by debt consolidation. This shows that debt restructuring is one of the more costly reasons to take out a loan. On the other end of the scale, the average loan amount for vacations is the least costly reason. This may suggest that consumers may use other finance methods to cover the cost of vacations.